Central banks throughout the globe are currently creating money. So here's the major question. We are taught from an early age that money is difficult to come by. We should study and work our whole lives to acquire it. Now, how can all of this money appear out of nowhere? How is money created? Who will pay it back? What does all of this signify, and what will happen next? Today's video explores the various ways money is generated and its potential repercussions. I'll also show you the underlying causes of wealth disparity. I promise if you watch this video all the way through, you'll have a good understanding of what's going on in the financial world today. Let's begin. The first kind of money is manufactured by the government. In reality, it is outsourced to the central bank Royal Mint, but the government retains control. Physical money comes in two forms: paper money and coins. Physical money is a minuscule proportion of the economy. In many nations, it accounts for barely 3 to 8%. Physical money is generated to cover the debts of private banks. When you go to an ATM and attempt to withdraw money, banks need to make sure that they have enough cash to satisfy those commitments. So let's take a $10 note, which costs around 3 cents to produce. This note indicates that the government made around $9.97 in profit on the creation of a $10 note. So you might ask, why don't governments just manufacture physical money when they can benefit from printing and minting coins, reducing taxes on the public? You see, the primary reason governments do not produce the bulk of money is due to politicians. If the person in charge could create money at whim, there would be a significant conflict of interest, and there would be a desire to keep printing to fulfill campaign promises or finance wars. This might theoretically undermine the currency by excessive printing, resulting in catastrophic depreciation. The more money in circulation, the less its value, which is a critical fact. For example, if tremendous inflation occurs and the ordinary Joe has $1 million, but that $1 million only buys an apple, how much is $1 million worth? Inflation is the loss of the buying power of money over time, and when it grows too high, money becomes worthless. Argentina, Zimbabwe, and Venezuela are among the most recent instances of runaway inflation. As inflation rates rise, people lose trust in their currency. For instance, in Venezuela, some individuals spend money to manufacture purses and draw artwork since it no longer has value. Money may be thought of as a measuring stick for worth, a very elastic measuring stick that varies in length depending on how much is present. For thousands of years, gold served as the standard for determining value. Gold served as a tangible anchor, keeping the money supply under control and governments accountable. In 1971, President Richard Nixon stated that the U.S. would no longer convert dollars to gold at a set value. Since then, money, as a measure of value, has become elastic since the U.S. dollar serves as a reserve currency for all other currencies. Let's head on to the second type of money. Before we continue, PLS take a moment to like this video and share it with others. Let's continue. The private banking sector in most industrialized nations generates the great majority of the money generated today. Banks generate around 97% of the total money supply digitally, hence the majority of money in the world is generated by private banks that pioneered digital money. When they were able to convince legislators after many early bank runs. A bank run is an occurrence in which depositors attempt to withdraw all of their funds at once, but the banks do not have them. As a result of these incidents, banks claim that they should be legally authorized to produce more deposits than exist based on debt, which is how governments outsource the production of digital money. The concept of utilizing debt as money dates back far further to 1704, when English entrepreneurs laid the groundwork for banks to become the world's moneymakers. The English Parliament approved the Promissory Notes Act. Promissory notes, in this situation, is a written commitment to repay the $20 you borrowed. Under the law, this piece of paper was equivalent to $20. Today, we digitized this agreement and called it debt. In this video, the term debt refers to the ability of banks to allow the circulation of debt notes as currency. From this moment on, banks were free to generate and destroy debt, and money from themselves was leased out at interest. As you can see, the whole global economy is built on these promises. Let's examine how it works now. When you go to a bank to borrow money, the banking license authorizes the bank to generate money every time a loan is issued. In the double accounting system, if you purchase a $500,000 home, the bank establishes $500,000 in their account and $500,000 in debt, which you agree to repay with interest. This $500,000 debt may enter the larger economic system because when you acquire the property, the owner could utilize the new debt generated by the bank that they got from you to purchase other items in the economy. To achieve greater growth, our existing economy requires more debt. It's important to note that debt is simply another kind of money. To the lender, it is a monetary asset. To the borrower, it is a debt obligation. But the two are the same. It sounds complicated, but all you need to know is that when a bank issues a loan, it is not someone else's savings, nor is it money that the bank already has. It is essentially brand new money that they create. They simply type it into a computer, and it appears as a digital representation of the government's money that you can spend. The bank benefits from this fresh money because they can charge interest on it, which is how they generate a profit later. When you return this loan, the debt and the money both vanish, but the bank's profit from interest remains. Banks utilize the real estate and property markets to create digital money because it is a secure and lucrative way to create debt. If a loan is not repaid, the bank can simply seize the borrower's home. The mortgage industry in industrialized countries backs up large sums of money. This cycle, which has continued for decades, has resulted in one of the world's largest property bubbles. We are hooked on debt. Yes, we were addicted to debt as individuals. Upon making a cash deposit into a bank, the money becomes the property of the bank rather than the depositor. The banks retain 10% of the deposits as reserves and may lend 90% of that money to another person. That person, in turn, may lend 90% of the money to another bank, which may then lend 90% more. This process is referred to as fractional reserve lending. It is important to note that any assurances of a money transfer to your account are false, as the funds are not transferred. When everything is said and done, a $100 initial deposit with a tempest and reserve requirement may result in $1,000 in total cash circulation. That was how it worked until March 26, 2020, when the Federal Reserve announced a 0% reserve requirement. This action eliminated reserve requirements for all depository institutions, end quotes, allowing banks to create infinite amounts of money with no reserves. It doesn't stop there. When banks hold your deposit, they, like hedge funds, can gamble with it by investing in financial instruments such as derivatives and securities. They do this to maximize profits. Most of the time, these instruments are just wagers on whether the price of an asset will grow or decline, but when carried to extremes, the results may be absurd. The issue now is that banks are gambling with so many derivatives, some of which are layered on top of one another with leverage-increasing factors, that no one knows how much money is at stake. According to some estimates, the derivative market is worth more than $1 quadrillion, or 10 times the world GDP during booms. Everyone takes on debt, which is loans from a bank, and spends it on things they couldn't otherwise afford. But this causes economic growth. Eventually, people can't afford to take on more debt and can't pay it back, so the bank stops lending, defaults occur, and the economy suffers. This is normal and has occurred for ages, but in 2008, everything changed. The world did not want to go through the agony of a downturn, and some observers believe this was the exact time at which the real economy perished. In 2008, banks had become so intertwined and integral to the supply of money that when they were about to collapse, governments had to use central banks to bail them out. Banks create 97% of all money as debt, which, if not paid back, can lead to systemic failure and collapse of the entire global monetary system. The economy has been on life support since 2008, after being declared dead. A decade of ultra-low interest rates, which eliminated the cost of borrowing money, resulted in massive market inefficiencies that exacerbated the overall situation. There were short-term benefits for the outcome of long-term discomfort. When private banks make dangerous bets and lose money, central banks may intervene with their unlimited funds. To recap, private banks produce the great majority of money, around 97%, by issuing loans, which is debt. The technique is as easy as entering numbers into a computer. Banks may spend and risk customer deposits to some degree since they legally control them and are too large to fail. Banks are backed up by the central bank, producing a moral hazard, which leads us to the ultimate and most irrational kind of money production. What is your take on this issue? Leave us your comments, and do remember to like and subscribe. Thanks for watching. See you in the next video.